Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. It's complicated because the economy is complicated. That was how one long-tenured, exasperated economist this week described the environment at the moment. Another described it this way: the economy will break one way or the other. We will see either a deceleration or it will reaccelerate. Okay, then. We characterize the environment as one that is in the midst of cross-currents. We agree with the way yet another summed it up: cooling, not collapsing. All right, this week our three things are: 1. Economic lines of defense. There are significant countervailing forces to slow down. 2. Q3 earnings. Still positive growth is forecast in the face of rising costs. And 3. Jobs revisions. The most important jobs data point this month might be next week, not Fridays. All right, let's dig a bit deeper. Economic lines of defense. So the Fed, or at least those representatives that contribute to the summary of economic projections, says longer-term real economic growth in the U.S. is 1.8%. As growth has slowed materially from 2.8% in the second half of 24 to 1.4% in the first half of 25, market participants need to assess the likelihood we move lower still to essentially stall speed. That, of course, would not be favorable to the price of risk assets, especially given where the prices of risk assets are today. And while our own forecast for growth in 2025 is 1.2%, implying more of the same for the second half, we believe there's a 70% chance the U.S. avoids recession over the next 12 months. As we head into what promises to be a volatile last 4 months of the year, here's how we are thinking about what's next. Let's start with what businesses are facing. Policy uncertainty that continues to take its toll on the top line. Inflation and tariffs that have been hitting and are set to hit the expense line. While those trends are clearly not our friends, for risk premia and credit to build, you need a shock. Historically, that shock is something that materially weakens the labor market and/or the financial system. Something to catalyze an inflection point. Whatever that might be, it's important to take stock of the lines of defense in this cycle that any shock would have to break through. Let's start with the strong financial starting point consumers and businesses in the aggregate find themselves in, having benefited from massive stimulus in the pandemic era. Then factor in the strength of the financial system, where strong bank balance sheets are complemented by well-functioning public and private capital markets. Next, factor in additional stimulus due to flow in from tax cuts and business incentives, courtesy of the One Big Beautiful Bill. And let's not forget that the Fed is about to reduce restrictive interest rates as it is set to embark on another rate-cutting cycle with 3 to 4 cuts by mid-year 2026 forecast, according to Fed Funds futures. Then, consider the following. First, businesses are enjoying the tailwinds of secular growth in technology and, at least for the time being, powerful wealth effect from stocks that have gone up by 38% since January 1st, 2024. Second, businesses are reporting historically high margins, which allows them to absorb higher costs without cutting into muscle. And third, business cost structures are relatively lean. They have held back on hiring since the inflation scourge that surfaced in the fourth quarter of 2021, and since then the hiring rate has fallen from 4.6% to 3.3% today. That's below the long-term hiring rate average of 3.7%. Add it all up, and credit, especially higher quality credit, is reasonably well positioned to continue to ride out slowdown. All right, on to our second thing, Q3 earnings. Now, following on the back of Q2 earnings that surprised significantly to the upside, the outlook for Q3 earnings is coming into focus. Strong tech earnings, rebounding wealth effect, and less than expected tariff impact drove 11.9% year-over-year earnings per share growth for the S&P 500 in Q2 versus expectations of just 4.8% coming into earnings season. Stripping out the Magnificent Seven, the S&P 493 reported earnings growth of a respectable 8.1% versus expectations coming into the quarter of just 2.5%. So what's ahead for Q3? Well, according to FactSet, The consensus is calling for earnings growth of 7.5% on sales growth of 6.1%. Expectations are for earnings growth to slow for both the Mag 7 and the 493 to 14.5% and 5.5%, respectively. Guidance is basically split, with 46 companies issuing negative, while 52 have issued positive. Of the 52 issuing positive guidance, 34 are in infotech. In most other sectors, companies issuing negative guidance tops those issuing positive. In 3 sectors, analysts are forecasting modestly negative earnings growth in the upcoming quarter, those 3 being consumer staples at down 2.6%, consumer discretionary down 2.7%, and energy down 4.9%. Meanwhile, double-digit growers include cyclicals, industrials up 10.2%, materials up 15.4%, as well as utilities up 16.5%, and infotech at plus 20%. Now, pulling back, analysts are forecasting full-year 25 earnings growth for the S&P 500 of a quite healthy 10.6%, with only energy showing a decline year over year, and that's a modest one at that, down just 2.5%. Looking ahead to 26, growth is forecast to accelerate again to 13.4%, about double the long-term average. Here's where we get stuck. So we have to assume that analysts really aren't taking a view of whatever policy-related drag lies in store, mostly because uncertainty around that drag remains high. Regardless, earnings are one piece of the puzzle, probably the most important piece, that keeps risk asset valuations high. Just how vulnerable those valuations might be remains to be seen. All right, on to our third thing, jobs revision. Now, Friday's jobs report is shaping up to be one of the most consequential reports in years, but the more impactful release just might be the one that comes out next week, the BLS benchmark revision for the period from April 2024 to March 2025. This exercise aligns the establishment survey in the jobs report with the quarterly census of employment and wages. More than you needed to know. In any event, the previous revision for the period from April 2023 to March 2024 caused quite a stir, as it initially reported that a whopping 818,000 fewer jobs occurred in that period than what was originally reported. Eventually, that figure was reduced to a still whopping 598,000. So what's in store for the upcoming revision due out September 9th? Well, another big downward revision. Estimates range from a loss of 475,000 to 900,000 jobs from the originally reported increase of 1.8 million. That would take the average monthly gain in the period from April 2024 to March 2025 from 147,000 to a range between 72,000 and 107,000. Quite frankly, that range squares up better with the no hiring, no firing narrative currently hanging over the labor market. It also is consistent with the various survey data. And for what it's worth, Fed Governor Waller said this week that he expects the revisions to be 720,000 jobs lower than what has been reported, and that the economy actually lost jobs, he thinks, from May through July of this year. You can imagine what the political response to the revision will be. You could also imagine the pressure on the FOMC to cut rates by a greater magnitude and a faster pace as a result. Stay tuned. So there you have it. 3 things in credit. 1, economic lines of defense. We're slowing, but there are significant forces keeping the U.S. growing. 2, Q3 earnings. We'll learn more about the impact of tariffs and uncertainty, but we expect growth from both the Mag 7 and the other 493. And 3, jobs revisions. Expect fireworks around September 9th's benchmark revision. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.